Hi, this is Phil Hall of Mortgage News Network, and today we're privileged to have with us Ted Tozer, head of Ginnie Mae. Ted, thanks so much for being with us. The first question I have for you is a potentially rude question. Why do we need Ginnie Mae in today's housing finance world?
Ginnie Mae, our position we have is we basically make a mortgage which is very, very unique. Every mortgage is different from the standpoint of the home, the credit, the borrower, and what we do is enable you to commoditize it, because all of a sudden the borrower's credit is replaced by the U.S. government. So at that point, investors all around the world don't care whether the loan is located in Arizona, Massachusetts, Maine, Wyoming. They don't care. They look at it as the U.S. government's backing up that loan, and that way we're able to bring in literally trillions of dollars worth of mortgage credit in the United States because of the fact that investors don't have to worry about the credit risk.
As the head of Ginnie Mae, what do you see as the greatest challenges facing your agency today?
The biggest challenge we're running into is historically Ginnie Mae's been heavily dominated by banks. We've always had a large contingency of non-banks that were our issuers, but the major players were your Wells Fargo's, your Chase's, your Wachovia, before they were bought by Wells Fargo. Those are the major players. Now we have new entrants that are coming in that don't have the regulation of the FDIC, the OCC, which are regulators look at the safety and soundness. They have plenty of regulation when it comes to the CPB as far as customer experience, but as far as actually their financial soundness, that's a concern, because like I mentioned before, the United States, we're stepping up to say that when an issuer issues a security, we're guaranteeing that that bondholder will get their principal and interest every month, which means we have to make sure that they're financially sound so that our guarantee is not called upon.
Well, Ginnie Mae, of course, is not a government-sponsored enterprise, but there are some people in the debate for the reform of the GSEs saying, well, the federal government really shouldn't be in the housing finance market at all. How do you respond to those type of comments?
Well, the question comes down to is exactly where does government get involved when you're talking about credit losses that occur on a consumer. I agree that the government should have possibly a small role in supporting credit risk for the consumer unless it's truly a mission critical, like for example a benefit for a veteran or underserved market the FHA is doing. But for the average American, the credit risk should be held by the private sector. But the key, like I got to before, Ginnie Mae's issue is the fungibility. It's the idea that people can literally trade billions of dollars of Ginnie Mae's in a 5-minute phone call because of that government guarantee. And that enables you to have a 30-year fixed rate mortgage, because it's a situation where if somebody has a mortgage, a whole loan mortgage on their balance sheet, they just can't sell it and get rid of it if interest rates are going to go up. But if you own a Ginnie Mae security, it's just like owning a stock in the New York Stock Exchange. You can pick a phone up, say you want to sell $500 million of Ginnie Mae's, and it's done in 30 seconds, just like selling your stock. By doing that, people feel comfortable investing 30-year mortgages, knowing they can get in and out on a 5-second phone call. And that's the reason why I think the government needs to be involved to support the interest rate risk, not the credit risk, interest rate risk, because in the savings industry disappeared in the 1980s because they tried to hold 30-year fixed rate mortgages in their balance sheet and found they couldn't do it, and they actually wiped out a whole industry trying to do that. Through Ginnie Mae, the government's able to find investors who will want to take interest rate risk that can actually manage that risk, and that's where the government guarantee is really critical.
Well, another question that might be potentially rude, just playing devil's advocate. If I was an investor, why would I want to invest in Ginnie Mae as opposed to investing in Coca-Cola or Amazon or anything else that's being traded today?
Well, the difference is because if you're investing in Coca-Cola, Amazon, whatever, you're buying stocks. And stocks are basically understanding the people's business model, understanding their profits or whatever. Ginnie Mae is truly, you're buying interest rate. It's like you buying a CD. They're buying interest in a cash flow, and they're not worrying about the underlying competitors to the company. For example, you're buying stock in a company. They're just simply buying cash flow. So if you're a pension fund and you know that you need to earn 5% interest for your 30-year liability for your pension, Ginnie Mae's perfect, because you want to lock in a fixed rate investment for a long-term asset, because you have a long-term situation with a pension fund. So with your pension you're managing. So that's the people that buy Ginnie Mae tend to be pension funds, life insurance companies, people that need long-term assets, and they want a fixed investment return, and Ginnie Mae gives that to them.
Well, Ginnie Mae also has a lot of people investing from outside the United States. people from around the world are seeing what our housing market is like, and yet they're still investing in Ginnie Mae. Is this a credit to your agency for putting out such a strong product?
Well, again, the reason the foreign investors like it is because they're not concerned about the actual credit losses. Because if you're an insurance company in Taiwan, insurance company in Tokyo, or a bank in Tokyo, you're in a situation where you know you're going to get your principal back. And that's what it's all about. So whether the housing market here is soft or really strong, the only reason they're concerned is, are people going to refinance, which would shorten their life of their investment. And that's the only risk they want to have. They don't want to worry about the credit risk. And because of that, housing market being soft doesn't make a difference. And that's the reason we've been able to help the recovery, because even though the housing market's soft, we've been able every year to raise $300 to $400 billion of money for the housing sector. Even though people would say it's weak, it's because the government guarantee is there to say you're going to get your principal interest every month, no matter what.
Ginnie Mae also had some new rules that were just issued for their issuers, for the benefit of our viewers who weren't keeping up to it. What are these new rules, and how do they impact your issuers?
Well, two of them. One, we basically are saying that as you continue to grow your Ginnie Mae portfolio, or your obligations to us, we want you to hold approximately 1 year's worth of servicing fee as capital, as income, so that when losses do occur, because like I mentioned, these are actual obligations of our issuers, that we're guaranteeing their ability to make up any losses in their portfolio. So we make sure they have plenty of capital. We're also worried about liquidity, because I mentioned before, a lot of our issuers now are non-banks. Banks have no problem with liquidity. They have deposits, checking accounts, everything else. But if you're an independent company, you've got to rely on money from Wall Street, from banks to have lines of credit and so forth. So we've now increased our amount of cash, or cash equivalent type assets you have to hold on your balance sheet, again, to make sure they get through the rough spots. Because right now, with the quantitative easing the Fed's doing, the bank's system is awash with cash. Once quantitative easing stops, and that liquidity dries up for the banking system, one of the first places it's probably going to hit is our issuers. We make sure that they have this cash set aside for the rainy day. So when it happens, they're able to do it. So we're asking to potentially hold back for every $1 billion of servicing to hold $1 million worth of cash on the balance sheet.
Mr. Tozer, you go to a lot of conferences, like the MBA conference here where we're at now. What are some of the main concerns that you hear from people across the industry relating to both Ginnie Mae and housing as a whole?
Again, I think the biggest issue we're all talking about is what does it take for lenders to start lending again? Like I mentioned before, our issuer base has gone away from the depositories into the non-depositories, and again, we're just trying to figure out why. Historically, banks have always looked at mortgages as kind of the bedrock of the retail banking, so they've always been a major player, and now they're pulling back. So again, I think the key for the industry is figuring how we can get them back in. Is it issues around the reputational risk that's come up with some of the bad press that banks have got about their servicing? Is it because of capital rules and a Basel III? What are they? And then is there any way for us to mitigate some of those issues so we can get the banks back in that historically have a really good match to be a long-term mortgage originator and player, and up to me not so reliant on the non-depositories in the system.
You've been at the head of Ginnie Mae, I believe, for 5 years now. What do you see as your greatest triumphs in the past 5 years?
I think the biggest thing that I like to think is that people look at us as a organization that's not a government agency. They look at us from a perspective that they hold us to a higher standard. They hold us to a standard that when we do things, we're going to be customer-centric. We're going to ask questions. We're going to do things that enable people to feel like we're partnering with them. And that's what I think is probably my biggest accomplishment, is to have people begin to look at us as a partner, not as a government. Because historically, the government sometimes is looked at as being almost a dictator where they demand things and there's not a lot of input. And I think people begin to look at us as more of a partner where we're trying to find a middle ground. We have an issue, just look at issues with our liquidity and capital changes we announced. It's been very little comment about it here at the conference, because I think most people think it was well thought out, it was well conceived, and with some input. And I think that's where I think I've done, is get people to think of themselves as a partner, not as a government agency that tells people what to do.
Well, you came to Ginnie Mae from a background in the private sector. Do you think that was beneficial as opposed to coming to Ginnie Mae for a career as a government bureaucrat?
Oh yeah, I mean, it helped a lot. I mean, to be on the other side of the table It really enables people to, helps me to kind of explain to people, even in Ginnie Mae, kind of where people are coming from, because we're not side of the table. And also, too, it was also good, too, because, like I said, I was a Ginnie Mae issuer. The organization I worked for, I then approved the Ginnie Mae issuer back in 1987. So I've been dealing with the Ginnie Mae staff for well over almost 25 years. So because of that, they all knew me too. So I showed up. It was kind of a situation where it helped as far as my background, but also helped them to know when I came in that they knew kind of where I was coming from even before I showed up, because I've been talking to them for 25 years as a major issuer.
I don't want to give the impression that we're trying to push you out of office, but how long do you plan to stay at Ginnie Mae?
I don't know. I mean, to me, I just like to stay as long as I feel like I can make a contribution and things to work. And plus, I'd like to stick around long enough to know that the changes I've made become permanent, with the standpoint that the people are in place, the procedures are in place, and so forth, that it can carry on. Because I like to think that the work that I put in, the time I've been there, isn't for naught. That it doesn't go back to being a rigid government bureaucracy, that that people continue to look at it as being something that they can look at as being a partner, and that's where along I like to stay, and hopefully I'm able to do that with my 2 years I've left, since I'm basically I am a presidential appointee. So with the administration change, I'm sure I'm going to be a different person sitting in this position.
Looking forward into 2015, what do you see as both the state of the housing market and the state of the overall American economy?
I mean, I think housing is going to continue to do better. I mean, I think the people want to own a home. All the surveys I've seen, you hear a lot of people talk about the millennials. I think the millennials want to own homes. The key thing, I think, is just the concept of, again, getting the people to feel comfortable to lend and to get through some of the challenges we have of getting stability and the rules being established for lenders to lend, so we can lend, so credit access can become more available. And I think with that, I think home ownership will be good. The issue it's probably going to come down to is because of the global overcapacity of human capital, you're probably not going to see major increases in inflation or salaries, which means home prices are not going to go through the roof. But when I got in the business back in the 1980s, homeless were looked at as shelter. They're looking at something that was you had to live somewhere. You had to pay rent, you had to own a home. There's nothing about this concept that I'm going to buy this house and it's going to triple in value and make all this money. It was all about having a place that was a community you want to live in, a place you want to raise your family, and it was a cheaper alternative than renting. And it was a place that you call your own. And I think we need to get back to that, where homes are looked at as being a way to get rich quick. It's looking at a place you want to live and a place that you really want to be yours. And if you make a few dollars on appreciation, that's gravy. But the way you're buying it as a shelter. And I think that's what we need to get back to.
Ted Tozer, thank you so much. It's a privilege to be with you.
Thanks. Okay, thank you.
This is Mortgage News Network.